Maybe you're starting to explore a career as an appraiser and want to know if now is the right time to get started. Or you're measuring your career span in decades and want to find out more about the latest apps, technology, and resources that can make your life and work a bit easier. Get the answers and insight you need with Beyond the Numbers, a podcast from McKissock Learning. I'm Julie Mohlendorp-Floyd, course and curriculum developer and instructor here at McKissock. Join me and an expert guest each week as we dive into the topics that matter most to appraisers, from industry and education news to marketing and other insights to help you run your business more effectively. If you'd like to stay at the forefront of appraisal news, boost your career, or just learn more about the profession, subscribe to Beyond the Numbers with McKissock Appraisal at Apple Podcasts, Spotify, or wherever you get your podcasts. Hope to see you there soon.
Welcome to this edition of Beyond the Numbers. My name is Kevin Hecht, and I'm here today with a very special guest, Dr. Mark Calabria, the author of the book Shelter from the Storm. Mark is an economist and a very extensive background, and so Mark, if you don't mind, give us a little bit of history.
Of course, and it's great to be here, Kevin. So I'm currently a senior advisor at the Cato Institute, which is a Washington, D.C. based think tank. Prior to that, I spent 2.5 years running the Federal Housing Finance Agency, which is the primary regulator for Fannie Mae, Freddie Mac, and the Federal Home Loan Banks. Immediately prior to that, I was 2 years at the White House as Chief Economist for Mike Pence. Spent a lot of time on Capitol Hill in the Senate Banking Committee, have worked in the mortgage real estate industry, worked in the Association of Realtors, Harvard Joint Center for Housing Studies, now Association of Home Builders, and have my PhD in economics from George Mason University.
Awesome. Quite extensive background. And not to simplify it, but from an appraisal standpoint, the very first question every economist gets asked is what's going to happen to rates?
They're going to move, but in all seriousness. So I would say my first forecast would be, I think we're about a 40% chance of a rate cut by the Federal Reserve in September. I recognize most market commentators are far above that. And in fact, it's not hard to find someone saying it's 100%. But I don't really think we're at a point where the clouds have cleared. I mean, yes, we've started to see considerable softness in the labor market, which the Federal Reserve has been looking for. But we've seen some false starts in the past year on inflation where you think it's done and it's still there. And this really is kind of a legacy issue for Jay Powell. So getting to the point where whenever he leaves, he's handing that over to his successor within the target range below 2%. So again, about a 40% chance of a rate cut in September, about an 80% chance of a rate cut by December, assuming that we continue to have this kind of softening. Now, if the labor market softens quicker than is expected and you start to see some real declines, then of course the Fed will move quicker. But I don't think we're at a point yet where it's suggested the Fed's going to take an aggressive cut. I do want to emphasize for the real estate industry, the Fed operates mostly at the short end of the curve. So just because the Fed lowers short-term rates by, say, 50, 75 basis points does not necessarily mean that long-term rates come down by as much.
And I think, from a boots-on-the-ground appraiser perspective, one of the things that we always think about is as soon as the Fed cuts rates, mortgage rates are going to fall, we're going to get busy again.
And it's not always one for one. I mean, it's also important to keep in mind, not to go a little too Econ 101, but the long-term rates embed an inflation expectation on the part of investors. So it really depends on why does the market think the Fed is cutting rates? Now, if the market believes that the Fed has beaten inflation, then you may see, close to a 1-to-1 decline. If the market thinks that the job market's going to get weaker and we're going to be in perhaps even a deflationary environment, then you may see rates. And you could even be in an environment where the long-term rates decline more than the short-term rates. But it really depends on the factors we see involved. Where we are in the economy today would suggest to me that by the end of the year, I'm expecting about 75 basis points in short-term rates, and I'm expecting about 50 basis points of that to flow through to mortgage rates. Okay. But it's an ever-changing, don't have a crystal ball.
Yes, because if we did, we would be doing.
I'd be a lot richer and be, wouldn't be talking to you, Kevin.
No. Totally understand. So one of the other things that we talk a lot about, especially with the economy the way it is, the housing market specifically, is we have, I think what a lot of people perceive as a shortage of housing. Yeah. How do we address that? First of all, is that accurate?
So I think it's important to think in two different kind of mindsets. One is a sort of structural, and these are the things that look at, like, how many households do we have? What's the population size? What's the household size? And that's a different question than in terms of where we happen to be in the housing business cycle. So on one hand, we are in the middle of a correction in construction. We're about, what I would say, 4 innings into a correction in multifamily that is painful, is going to be more painful. We've built more apartments than we have since the 70s. That doesn't mean we have enough apartments. It simply means at that price point, you're going to see a correction. We're about 2 innings into a correction in single-family construction, but that's a cyclical component. Again, it is possible to be overbuilt at a certain price point in a certain part in the business cycle and still be structurally. And it's also important to keep in mind, as our realtor friends say, location, location, location.
Yes.
And I could joke that the housing shortage is solved if we all move up to Buffalo, New York. But that's not going to happen, and so there are the primary considerations are we have a tremendous amount of land use restriction zoning in the predominantly coastal areas like California. You started to see those spread a little bit throughout the rest of the country. You have had some pockets where they've liberalized, Minnesota, Montana, but let's speak of modest liberalizations that have been moves in the right direction. But it is still, by any definition, very hard to build in many parts of the country. And even as importantly, in many parts of the country like California, even if you think you've met all the rules, there are a lot of veto points. I mean, people can sue, people can have referendum, and time is money for a developer. If you don't know whether you can finish this project when you start it, you're less likely to start it. And the ultimate readjustment is people will simply continue to move out of California to places like Texas. Yeah. And so you're going to see that geographic reallocation. So the solution, of course, is to liberalize the land use process. And it doesn't mean you get rid of rules. I mean, you can sit here and say, okay, here's where single family, here's where multifamily. If you meet these rules, you can build. But I think we do need to try to move toward a right to build if you meet the rules and have less discretion in the decisions.
Right. So we're here at Valuation Expo, and Dr. Calabria just gave a segment to the appraisers. And one of the things you talked about, which I really found interesting, was the whole idea of how credit scores affect the housing market. Specifically, we used to talk about 100% mortgages. And now we don't have those technically.
But we still kind of do. Yeah.
Can you kind of explain how that works?
So there's different aspects to it. And let's first think about the credit box as a function of demand for housing. You loosen the credit box, you're increasing the demand for housing. And one of the reasons that prices have stayed high in the recent years is because the credit box is opened in a number of ways, and that's pushed up demand. Now, if you tighten the credit box, then demand will decline, and so this enters in two factors. A, it enters into increases or changes in demand, and that affects prices, but it also ultimately enters into delinquencies. And so one of the things I think is under-recognized is we've made a number of changes regulatory-wise to credit scores that have resulted in what I call, for lack of a better term, FICO inflation. Mm-hmm. And so you think about, there have been changes that the Consumer Financial Protection Bureau, the CFPB, has done to the reporting of medical debt. And obviously, if you remove medical debt from somebody's credit report, their FICO is going to go up. And in fact, the CFPB estimates that not even what it's proposed to do, but what it's already done will increase FICOs on the bottom end of the distribution by about 25 points. Now, as I talk about in my book as well, during COVID, we suspended reporting of mortgages and delinquency. And this was not simply a mortgage. Same thing was done for student debt, other forms of debt. And so my back of the envelope, which I've kind of road tested with the credit bureaus and others in this space, is that the typical FICO is probably about 30 points inflated relative to where it would have been in, say, 2008. And at the bottom, this really does make a difference. I mean, this could be the qualification between, whether you get a mortgage or not, whether it's a subprime or a prime or an Alt-A. And so I do think that we've made all of these changes that have shifted the credit score distribution up, but the industry itself has not really accounted for that increased delinquency. So all else equal, a 740 today is not what it was.
Right. And that goes to the what'd you call FICO inflation?
The FICO inflation, of course.
Yeah.
Vantage inflation just doesn't sound as exciting, But it's the same. It'll obviously same impact, depending on whatever credit scoring model you're using, and so that has increased the risk and essentially opened up the credit box. Now there's similar sort of concerns on the collateral valuation side as well. So in certain segments of the market, like FHA, we're not a HUD, you have the 97 LTV cap, but you can roll in the closing costs.
Right.
So it's typically the case, the average FHA borrower leaves the closing table underwater. And if you're already, we've been in an environment where there's been a lot of pressure on appraisers to go up.
Right.
Obviously nobody's happy with the number that doesn't come in. There have been regulatory pressures that I think have pushed in that direction as well. So I do worry, I should certainly say as an overall thing, that the average borrower, completely fine. The median is going to do fine. But again, the median did fine in 2008. It's really the kind of tails of the distribution. So what concerns me is you have about a 5-10% of borrowers where poor credit quality on the borrower in terms of a low FICO that's probably inflated, LTVs that are near 100 or higher, debt to incomes, DTIs that are close to 50. And that high DTI really kicks when you see increases in property taxes and homeowners insurance. And one of the things we saw during COVID that was interesting was DTI was the number one predictor on who took forbearance during COVID. And it is really a good measure of the household's ability to survive a stress cash flow position. So I'll say overall, glass half full, as long as the labor market performs, the mortgage market and housing market's going to be fine. But if we see prolonged problems in the labor market, we've structured the credit box in such a way that there's a segment of the housing market and mortgage market that is very closely tied to performance in the job market. That historically was not the case. You go back to, say, the 1970s, 1980s, and fluctuations in the unemployment rate had very small impact on mortgage delinquencies. And now we've amplified that effect.
I think a lot of things in the housing market have been amplified over the last
Absolutely.
couple of decades.
It's not your grandfather's or grandmother's housing market anymore.
So one other thing is, we kind of wrap this part of the thing up and we'll talk about the book, but you mentioned something else that I think is very important. Like, where do you see the appraisal industry going in the future? And specifically, what can appraisers do to kind of...
So I can't overstress that. To me, the industry is at a crossroads. And it really... the fate of the industry, to some extent, it is in its hands if it decides to step up to the table. So, my experience in Washington regulating Fannie and Freddie is there's a lot of Washington that simply sees the appraisal as a compliance exercise, a box to check, a friction.
Right.
And I can't tell you the number of times I've heard people describe it as a friction to be ironed out. And so, to me, I'm offended at those sort of perspective. To me, the appraisal is an important part of not simply protecting the value of the collateral for the lender and for financial stability, but also for the borrower. Because there's always so much pressure in an environment where you're lucky to find the house, that the pressure on you to bid, we have this thing, econ called the winner's curse, where you can find yourself in that situation. And so the appraiser, I guess if you're a borrower and the appraiser comes in lower than what the seller's asking, that's a message to you.
Right.
And you shouldn't be angry. You should be thankful that somebody. But that's not how it works out.
Right.
So, point being, the industry, in my opinion, really needs to make the case in Washington, but also just to consumers writ large, why this is an important protection for the borrower, because that's not currently the lens. And so there's just so much pressure from the GSEs and others to ultimately, what I would say is do away with the appraisal.
Right.
And that worries me because it is an important safeguard, but so much of the pressure in the mortgage market is to erode the safeguards. And so, as you heard me say earlier, in Washington, if you're not at the table, you're on the menu. And I do think it's important that the appraiser industry needs to be at the table, and they need to be vocal about it.
And so for anybody that's taken a class with me through McKissock, you hear me say something very similar. Now you hear it from a PhD, so please take note. So as we wrap up, you wrote a book called Shelter from the Storm, How a COVID Mortgage Meltdown Was Averted. And I think, from an economic standpoint, there's a lot of lessons that we take away from that. Can you tell us a little bit about the book, what it was about? And
Sure. And it actually goes back a little bit. I mean, the book starts in January 2020 and kind of walks you through how we were trying to navigate the housing and mortgage markets during COVID. And it really walks you through why 2020 was not another 2008. And again, everybody at the beginning of 2020 thought it was going to be. The forecasts were that the housing market was going to fall off a cliff. And in fact, in May 2020, home sales declined by a third. Everybody's forecast was for price decline. So, that big boom that happened was a surprise in some ways. In the book kind of walks you through our decisions we made, why we made them. And as someone who was a public official, I felt a real responsibility to kind of explain to the public why we did what we did. And is a part of history to go back and get that right, but as much to say, I'm hoping we never see another pandemic, but we will, we will see another downturn in the housing market. And the book really kind of channels a lot of my takeaways from what I thought didn't work in 2008 and why we decided to do things differently in 2020. And I think 2020 worked a lot better than 2008 in response. And so that walks you through that. And again, there's a chapter on agency leadership if you want to kind of know what it's like to try to navigate and lead a federal agency through a pandemic or even through normal times. It's got a lot of challenges there. I like to think, I've had people tell me my sense of humor flows through in the book, and it is meant to be very accessible. Perhaps the best feedback I got was when my mother read it. She told me now she finally understood what I did for a living. So it really is. It's meant to be kind of here's the development history functioning of the mortgage market through a pandemic for a layman, and it
That's
really
awesome.
is meant to be quite accessible.
And that's one of the things, I'm constantly trying to get people to understand is that economics does affect everybody. And so the more you understand about it and the more you learn about it, the better you're going to be as you go forward. So
yeah, and there are parts of the book where I walk you through kind of here is the economic theory and the structure of incentives and why we designed the program certain ways and why they turned out. So for instance, as we wrap up, I'll give you this example. Coming out of 2008, as you remember, 2008 was the weakest job recovery post-World War II. And one of the reasons it was such a weak recovery was the mortgage programs were set up in a way, HAMP and HARP and these other programs, where your mortgage relief was 30% of your income. Now, the flip side of that meant that for every dollar you earned, you lost 30 cents in relief. Mm-hmm. And that's just on the mortgage side. You add in taxes, you add in other issues, and you get very high implied marginal tax rates. And so, quite simply, if you're in a situation where you earn $1 and you lose most of it, you're less likely to earn $1.
Yeah.
So we decided that instead of structuring the programs in a way where they were means tested, we made it time tested. Because, we assumed, okay, it'll take you 2 to 3 months to get your unemployment insurance check because, unfortunately, that's how unemployment insurance works. You don't get it immediately. And so we wanted to create a bridge where we gave people basically 2 to 3 months. And, in fact, about a fourth of borrowers were in for less than 3 months. They got in, they got their UI, they started paying their mortgage back on their feet. And, in fact, by the time I left FHFA in mid-2021, about 90% of Fannie Freddie forbearances had ended. People got in, got out. And because we made it time limited, not income limited,
Right.
So we didn't want to punish people for going back to work.
Yeah.
And I think that's one reason you had such a strong job recovery in the second half of 2020. Yeah. So incentives matter. It's a big part of it.
Very good. And where can people get the book?
You can get it anywhere. It's at Amazon. You can, of course, go to cato.org, and there's a number of links to Barnes & Noble and many other places. So anywhere that you go online, you can find your fine booksellers.
All right. So I encourage everybody to go out and get a copy of that. Dr. Calabria, thank you very much for being with us, and thank you, everyone, for taking time to listen. If you have any suggestions or comments, please put them in the chat box, and we'll catch up with you later.
Thanks for tuning in to this week's Beyond the Numbers. If you'd like to stay at the forefront of appraisal news, boost your career, or just learn more about the profession, be sure to subscribe to Beyond the Numbers with McKissock Appraisal at Apple Podcasts, Spotify, or wherever you get your podcasts. Thanks for stopping by.